Great. So today being the third day of the intervention class, we will look at the interpretation of financial statements and corporate governance. Good. So interpretation of financial statements. So interpretation of financial statement. Interpretation of financial statements. Good. Now over here, we have to provide meaning to the financial statement that we have prepared. So the financial statement prepared, we have to provide what? Meaning to. So how do you provide meaning? How do you provide meaning? For decision purposes. For decision purposes. Good. So for decision purposes. Good. So that is the interpretation of financial statements. Though popularly we call it ratios. Look at why most often we call it ratios. Most often we call it ratios. So the tools that we use to provide the analysis, to interpret the performance, to reflect the company's performance, the tools that we use, they are tools that we use in the analysis. The tools that we use in the analysis, they are one, horizontal or trend analysis. Horizontal or trend analysis. That is the first tool that we use to analyze the performance of a company. Then, two, we can use what? Vertical or common size analysis. Finally, and almighty, we can use what? Ratio analysis. So these are the tools or the various ways that we provide meaning to financial statements. So the exam that you are going to write, once you are going to get ratio question, don't be far from these three, one of them, written as nice. Most often is the ratio. That's why we normally call this topic ratio analysis. Ratio analysis. It is not ratio analysis. It is interpretation of financial statement. Just that the tools or the techniques that we use to provide the interpretation, one of them is ratio, and it's the common one that everybody is aware of. So we are going to go through all this, and then we look at it. Good. Good. So we will take each of them one after the other and know how we can use each one, because if each or if this, they are the techniques that we use to provide meaning to the financial statements, then it means that we should know how to use horizontal or trend analysis to explain the performance of what? The company. That is all. Performance means the guy is doing good or bad, and its implication, the impact. Good. So that is it. Now, let's start. I'll start with the horizontal analysis first, about 1 to 30 minutes to 45, 30, 30, then we see. Horizontal analysis or trend analysis. As the name suggests, horizontal line, like this, right? It means that we are analyzing the company's performance over time. Analyzing the company's performance over time. So that is it. So the same company, but different reporting year. Usually it must be more than one from two going. So we can give you 2019, 2018, 2017 years, 3 years, 4 years, 5 years. That is a trend analysis. Good. So horizontal analysis compare company's performance over time to obtain trend. To obtain your trend. To look at the direction of their performance, whether the direction look good or look bad, whether how things are going, they have a good future, or whether the future will be good for them. That is the trend analysis. Good. So basically, so how do you calculate? Yeah, all these tools, you do calculation first, some percentages first, some figures first before you use for your analysis. None of this that we don't do calculation before. All of them require calculation. So with the trend analysis, first you have to determine what you call percentage change. Percentage or change, that's a trend. So first then you have to calculate the percentage or change. How do you get it? The formula is only one. It's equal to the new or the current year, the new minus the old or previous year, all divided by the old times 100 times the 100. That is the game. Now, because the formula is going to be the same throughout, we don't need a formula in exams. Likewise, we don't need the workings. Just point on calculator, throw the answer in for us. We are done. So that you can be fast. Because it's a lot. It's not like ratio that you need maybe one or two or three. You are done. No. Here, everything in the financial statement, you have to find the trend analysis. So we are going to back it with what? With illustration. First, we provide a calculation. When you are done, then you analyze it. So use a question like uncle. So the next question in the intervention kit, uncle. So let's use uncle to back our analysis. So uncle. So let's go to uncle. If you do have uncle, you can move with us. Uncle. So it means that you have to get the material. Yes. Kindly open it on another device so that you move with us. But if you don't have it, kindly let me know and see if I can project it or send it to you. That's this morning's on. Great.
You're saying the steps. So first one, calculate the percentage. The second
Good. So first, you calculate the percentage change before you do the analysis or the report about the performance. So that's what we will do first. So the question will be uncle. Uncle. That's the question 2. Uncle. So question like this, how do you get the trend analysis? Now there's a requirement there. I will change it slightly. The requirement there, I'll come with our own trend analysis requirements. Please, when they say trend analysis, they don't need ratios. It's still the same financial statement that we are going to use to provide the trend analysis. They don't need ratios. Okay, good. So kindly open to this question so that I'll take you back to the screen. Okay, so that is it. Now we will add this requirement to it. Using trend analysis,
So C.
yeah, C. So C, ankle, ankle, C, using trend analysis, analyze the performance of ankle. Using trend analysis, analyze the performance of ankle. Analyze the performance of what? Ankle. Analyze the performance of ankle and recommend or suggest whether the facility should be granted on ankle. Good. Okay. So that is it. So first, we need to calculate the percentage changes in the items. So that's the first thing you have to do. So let's calculate it and then use it to start the report. So I'll go straight and tell the examiner that C, I am doing trend analysis. So trend. As a calculation of the percentage change. Now, you have to arrange the years in order that to not confuse you. Yes, and that order will be based on how the examiner arranges it. Usually, we want something like this current year, maybe 2018, 2017, and 2016, 2015. But if the examiner have not arranged a question like this, you can also do this. So how they have arranged the question, that should be the same way we should write it. So if they start 2018, 17, 16, do the same. If they start 16, 17, 18, do the same. So this one, which of the style they started with? Good. So they started 2015, 20 what? 16. One thing about trend is that if I have 2015 here, 2016, 2017, and 2018. Now, we cannot get the trend for the first year. Why? We don't know 2014. But we said that trend or percentage change is equal to the new minus the old, all divided by the old times 100. So in 2015, we can't get the old, which is what? 2014. Unless that's the starting point. Unless the starting point. So that with the trend analysis, we start from 2016, 20 what? 17 and 2018. Even if you write the 2015 here, don't put any figure there, dash, 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 dash. Why? You can't get the change. You put dash, dash there, then you are done. So that is the game. So let's see. Then here the reporting currency will be when percentage, no reporting currency, percentages. But that's the percentage change. They take comprehensive insurance. The first item on the list, you bring it. When they move, you move. When they stop, you stop. If it's 2 years, that you can get for only one, right? If it's 2 years, you can get for just the current year. Then you are done. So the first item on the list will be So if you are calculating all the items given to you, if it's a sales, if it's profit and loss, you do for all. This is the financial position. This is just one question, right? Just one financial statement. Some of the financial statements you have P and L. So profit or loss, you do from sales up to profit after tax or the OCI. Then you come to the financial position. Then you continue in that order to get the percentage changes. Okay. But this financial position, so this is so first the first item on the list. Good. And first online, please give me some of the figures because I'm with that question. Yes. So financial position, the first item on the list, we have the non-current assets, PPE, right? So under PPE, so PPE, we have land and building, right? Okay, so land and building. Let's come here, land and building. Okay. Now let's do the calculation. So the first one, what do you get? So look for percentage change. Is the new minus old all divided by old. So if your first answer is ready, you can share with us. Great. So that's 2.23. So I'll put it here 2.23. So here when they move, we move. When they stop, you stop. Then you are done. Good.
So we do
Yes. Okay, so let's show working how you got a 2.2.3. So we are finding the trend analysis for 20 or 16. We can't get for 20 or 15. So for 2016, what's the 2016 figure? The land and building. So that would be 11
460.
minus the 2015 levels.
Yeah.
The 2015 levels is
11 to 10.
all divided by 11 to 10 times 100. What is it? Is the new, that's the year in question, that's 2016 minus the previous year, all divided by the current, so the previous year. Then you are only 10. Okay, so times 100 times 100. Good. Then 2017 get something like so 5.77, and then 2018 negative, right? 8.58. Good. So that would be the answers that you are going to get. First of all, for the purpose of our time, if I understand how to calculate one or two, we'll go straight forward to the report. But before that, I'll ask my own specific questions from here. So that is it. Okay. Now, from here, let's go to the non-current assets. So the one, two, three. I'm going to non-current assets. Have they totaled the non-current assets for us?
So, Fred, will we do the plant and equipment?
Good. For the items, financial position, every item, line by line. When they move, you move. When they stop, you stop.
Oh,
All the items. So start with the very first one, the very last one. That's the trend analysis. So the next item on the list is PPE, right? The so plant and equipment. So we get 11.2. Okay. So this is how you do it. You do it up to all the items. So randomly, let me ask few of them. If you're able to get it, then we have used sample techniques to finish the calculation.
so Fred, will we add up the for not
The non-current asset, you should not add the individual percentages. You have to pick the total given to us in the question.
so for 2016 we pick the 2356.
Great. Let's go to the stated capital. Then you do it for me. What is the percentage change? Then from there, I bring my own item. So that's you get it. Stated capital for the same question. Uncle.
So Fred, when it comes to the total assets to what do we do? I want to pick the total here.
How do you look for the percentage change? Stated capital. Percentage change.
Is it not the same?
Mm-hmm.
And it's 8,000, 8,000, 8,000.
So stated capital is 8,000, 8,000, 8,000. So what will be the percentage change?
Zero.
Zero. So here, if you see the same thing consistently, then it will be what? Zero. So there has not be any change. So zero. So stated capital will be zero. So zero, zero, zero for the 3 years. That is it. Then let me also chip in my own. Like you tell me how you do it, then we write the report, then we are done. So assuming that there's a figure like this, an item here, 2016, 17, 18, 19, and here is uh, cash. Let's assume that here is 60, here is dash, Yes, 40. Yes, dash, and here's 25. Or even here's dash. Good. So tell me how you do the percentage. Assume that something like this. Some of the years, no figures. How do you still calculate the percentage change? We are still interested in percentage change.
100%.
Good. So here, the percentage change will be
40%.
good. This is the amount. Let's say 60,000. It's in cities. So this is a financial statement. In the financial statement, cash balance was 60 cities, dash 2016, 40 is 2017. And we asked to find the percentage will change. So first, percentage change will be, you start from 16, right? Yes, dash. So if I should code the formula, it will be something like this: 0 minus what? 60, all divided by the previous, which is what? 60. Good. So, so all over 60 times 100, and that will give us
Negative 100.
minus 100. So minus 100 means the entire cleared. So negative 100. So it has decreased by what? 100%. That nothing has vanished. It has been written off. So you put it there as negative what? 100. So negative 100, that's the percentage. So in that case, whoever it's okay, you put the negative 100 there. How we get it? So it means that the entire item has been vanished.
Whenever we see dash,
The dash position that particular year will be negative 100. Then let's look at 2017 too. What do you get for 2017? What will the percentage change?
so that will be positive 100.
Perfect. 2017 must be positive 100. Why positive 100? But that one too, it has moved from 0 up to a certain figure. Anytime something move from 0 levels, wherever it reach is what? 100%. So it has moved from 0 to 40, so that's 100%. Then you go to 2018, it has dropped to what? 0, so that's negative 100. When something drops to 0, that means it's negative 100. So these are the little issues that we have with the trend analysis when you do the calculation.
So 2019.
2019 will be dash, no trend. But the thing is, no trend. So we don't have figure there. So we are done with the calculation. Let's see how best we can provide the analysis in event of trend analysis. So in providing the analysis, you can't talk about everything. No, you can't talk about everything in the financial statement. No, you can't talk about everything. So we are going to look at the important ones that we have to talk about. What are the important ones that we have to? So I'll list them. Then you start providing the report about them. You cannot talk about everything. But in calculation, you have to calculate about everything. The calculation was done by everything, but writing the report or analysis is not everything you're going to use. So let's see. I'll clean this one and write the item there. So the asset side, the same thing be done for the profit and loss statement. So I'll start the analysis from profit and loss. So from profit and loss trend, you need to talk about one, sales, two, cost of sales, and three, its impact on gross profit. Changes in sales, changes in cost of sales. How does it affect or how has it moved the cost, the gross profit?
So this is with the analysis.
Good. So writing the analysis, what I want to pick and talk about. Then right from the gross profit, you go straight and talk about the few operating costs, and then your five operating profits, and you talk about,
The two is equal to sales.
yes, cost of sales. Then there's this one is optional, the interest and tax. Then finally, profit after tax. So this is how what you are going to talk about. Can't talk about everything, just one line, one line. And by the time you finish, it will be like a full statement on its own. So first, sales, cost of sales, gross profit, operating expenses, and operating profit. Interest and tax. Then finally, we talk about profit after tax small. So let's go to the financial position item that you have to pick. Then we provide a sample, like to this question, how we should write. So for financial position, you pick one, the financial position. I'll take this section off. Let me start taking some part off here. Let me start taking some part off. Okay, with financial position, first, pick one of the PPEs. So PPE, probably one will do. So PPE, probably one will do. PPE, one of the PPE. The one that is experiencing a unique trend. The one that has increased or decreased, or the one that does not change, or exceptional. Good. So PP. Two, go to inventory. Very important. Current asset. Move to inventory and check whether the inventory is increasing. If inventory is increasing, what is the implication? This implies that we don't, or we are pushing much of our revenue generations or our cash flow into inventory. And if this continue consistently,
Increasing.
when inventory is increasing, that means we are piling our cash flows into what? Inventory. Good. Now, we said that if inventory is increasing over the period, and if this continue, that means we get to a time where we will pile up a lot of stock, unnecessary ones. If anytime inventories are going up, 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 a time will come to be out of date. Good. And then we will lock most of our cash in inventory or our capital in inventory. This is a dangerous sign. Good. So that is the implication. Then from inventory, you look at the impact on cash. All these ones, you need one, optional. They're not compulsory.
So we can add that it's a bad sign. Alright.
Here we are looking for encouraging trend or disencouraging trend or bad performance. Yes, if the trend is good or bad. how things are going. Is it good or bad? So that is what we have to tell the examiner. So that is it. We'll pick the first one and see. Like if you check land and building, here, has it increased or decreased?
Increase, decrease.
Okay, good. I like that. What about this plant and equipment? 11.2 and then 1.39. So it has decreased, right? No, we don't use the absolute percentage to determine whether it has decreased or increased. If you check on the face, in actual sense, it has increased. In actual sense, the actual value has what? Increased. Now let's see the total non-current asset. They did it there. Total non-current asset. They give us the total. When you check, when you perform the trend, what is the total non-current, the trend for total non-current asset? 2016 you had
5.97.
so 5.97 and 2017 to 3.86 and then 2019
Minus 4.40.
to 40. So I want to use this one as basis of reference. So for 2016, we had something like, let me take this one off from this, that no confusions. Okay, so for 2016, it's 5.97, but you can see it has dropped to what? 3.86, and then negative. So here, please and please again, as long as positive, it has not what? Decreased, it has increased. That's the interpretation. If we check the non-current asset itself, it has increased, natural fact. The real non-current asset. However, this suggests that it has increased at a reducing rate. It has what? Increased at a reducing rate. So it means that if you check the amount that it increased in 2016 from 2015, it is far, far, far higher than the amount that it increased from that level. Good. So that is it. So even though it has increased at a what? A reducing rate. That is it. I don't need to go further. Here, all what you have to tell the examiner is all what you have to tell the examiner is that the non-current asset of coal and coal has increased over the period, with the exception of what? 2018, which decreased. Once it's negative, negative means decrease. If it's positive, increase, irrespective of what? The figure. The figure represents the percentage increase or percentage decrease. Good. Once it's positive, positive means increase irrespective of the figure. Negative means decrease. Trend means increase or decrease. Change irrespective of the figure. So here you can see 5.9%, it has moved to 3.8. This does not mean that the thing has decreased. No. If you check non-current asset, it has increased, natural fact. Increase means longer is positive, it represents increase. Once it's negative, it represents what? Decrease. But the figures attached represent percentage increase or percentage decrease. So that means in 2016, the non-current assets of the entity decreased by 5.97%. In 2017, it was increased by 3.86. 2016, it increased by what? 5.97%. And a further increase of what? 3.86 in 2019. However, in 2018, it decreased by 4.40. How we get it? So that's how we provide the interpretation to that of the trend analysis. So here, if assets, you check, if non-current assets are increasing, what is it good news or bad news? So first, if you're writing the analysis, about 4 items that we need. Item number one, whether there has been a change. Some of the items, there will not be a change, especially share capital, if there's no issue any shares. Non-current liability, if does not increase. Good. So whether there has been a change in that amount. Two, meaning of the change. What does the change represent? Good or bad? Trend. A good trend or a bad or trend. So if it is non-current asset, if any PP increases, it's a good trend. It means that the company are not spending their money on dividend. They are spending the money on assets. And the more you buy assets, it's likely that you can use them to generate what? Inflow. So that's why I'm saying it's good. If there's a company and then your PPEs are going down, decreasing, the assets that are going to use to generate money, they are going down. And what money can you generate in the future? That's a bad trend. If this continues, you can't get asset to generate what? Cash flow. And it's a bad trend. That is it. Any company that is selling their PPE, they are not into business. Any company that sell, always, they are selling their PPE. Instead of acquiring more, you have to sell probably the one out ones. And then to replace them by new ones, fine. But you are not buying new. The little that you have to, always you are selling them. At time you can even get PPE to generate what? Inflows. Three, we know the meaning, good or bad trend. Then assign reason. Give us at least one cause of this. What caused the PPE to increase? Maybe they are buying or they are selling. What caused sales to increase? They increase the selling price or decreases cost of the cost of sale or decrease in their, how do you call it, the product selling price, and then instead of that, consumers are buying more. So basically, that is how we provide them in. And then
So, but
four,
it is good for every company to increase in PP.
yes, every company you have to increase your PP. Yes, make sure that you increase your PP. You don't need to decrease them. But the PPs are the one that you are going to use to generate your money, your inflows. They are going down, probably you might not be able. So even in, that's your non-current asset, all the non-current assets, they must increase all the time. They can also ask you to use cash flow to analyze the company's position. If the investment activity is negative, they are doing well. And investment activity will be negative if and only if you are buying more assets. That will be what? Outflow. Good. So that is it. Then the fourth position is that you have to tell us the impact and recommendation. The way, the direction that their PP is going, what will be the impact? Do they have safe future? Or if this continue, would they still be liquid or profitable? If not, give them a turnaround situation. Yes, because now they know that you are a financial guru, so you can tell them the turnaround situation, and then you are done. So if you pick any item, that's what you're going to write about it. I repeat, if the examiner said using trend analysis, we don't need ratio. But if they don't tell you which one you should use, then that means you have to use the ratio analysis. Basically, that is it. Okay, so we are done with trend analysis. So now note we are moving on successfully to common size analysis. So first, in summary, trend analysis, you are finding percentage changes in the value. Second, you are providing meaning to the percentage that you've calculated. And we've gone through how you can obtain these percentages. Good. Then you are done. Okay.
The four is what impact or what?
So the financial position, after looking at your PPEs and then slash your non-current assets, if they are going up, increasing, good news, decreasing, bad news. Here, your current assets, they should be moderate. The current assets should be moderate, not too increasing, not too decreasing. Because if you don't keep adequate current assets, you can't get funds to settle your current liabilities. So that's section 2. Then from there, you jump straight to equity. So equity will be the fourth person. You have to talk about equity. So changes, check the stated capital, whether they have issued shares. If the stated capital increases, meaning they have issued shares, and then you check whether the other component of equity too has also increased. Now, if the stated capital has not moved, but the equity itself has what increased, then it means that it's as a result of the other component of equity. That means as a result of what retained earnings or revaluation, which has caused the equity to what increase. Then number 5, check whether the non-current liability is going high. We are done. This 5 points should be okay for explanation. Check whether what yes, they have given us dividend. Yes, you have to also calculate. Dividend is also part if you are looking for yes the dividend. So non-current asset, check whether it is increasing or decreasing. If your non-current, sorry, the non-current liability, if your non-current liability is increasing, that's a danger. It means that your financial risk is also going what? High. Financial risk is a risk that attach to what? Debt. So if your non-current liability, the trend is increasing, 10%, 20%, you are going, increasing, increasing, increasing. It means that your financial risk is also what? Increasing. So check non-current liability. Then that's the end of the game. Okay. So basically, this is what you have to talk about. You can't talk about everything. Point by point by point, and then you are done.
In case they should ask about use.
When I ask for importance of trend analysis, you can just tell them that it allow us to know the changes in the performance of the entity over the period to give us the clear changes in the performance of the entity. Uh-huh. And also to know the direction, current direction, future direction, and then the past direction. So you just use it.
So is it the first one as well?
Great. So we can move on to the common size analysis. So common size, or we call it vertical analysis. Vertical analysis. Vertical analysis. Great. We'll take our first break after the common size. Then resume. So we are done with corporate governance. When we resume back, so we are done corporate governance. We look at ratios and good. So common size analysis. Common size analysis. Common size or vertical analysis. Vertical analysis. As the name suggests, if horizontal, it go like this. Trend. Vertical will be like this. Good. Vertical or common size. Here, we are going to express all the items in the financial statement as a percentage of the common base. So here, just express all the items in the financial statement as a percentage of a common base. And line common base. So we should know the common base of all the financial statements. There are about 5 financial statements. One is out, 11, 4. So we will look at all of them. They are common base. So let's see. I'll put the financial statement here and put their common base also here. Common base. So the first item on the list, number 1, comprehensive income or the profit or loss. Comprehensive income, what is the common base? The common base is what? Sales revenue. So it means that you pick all the items in the profit or loss, then divide it by the sales times 100. That's all. That is the common base. All the items in the comprehensive income, one after the other, one by one. You pick each of the items, including the common base itself, including the sales itself. So let's assume that I have a sales here of 140, I have cost of sales of maybe 80. I take it off, we get a gross profit of, let's say 60. Operating cost is 50. Net profit is 10. Good. So here, if I'm doing common base financial statement, I just have to express all the items as a percentage of what? Sales times 100. So if I pick sales will be 140 over 140 times 100. I'll get 100%. I'll put it in 100%. Now go to cost of sales. Cost of sales will be 80 over 140, each of the items times 100. Then 80 over 140, whatever I get, I'll put it there. So 57%. Then I'll go to gross profit. You can take it off. You get something like 43%. That's 60 out of 140. Pick each of the items and then divide it by the sales revenue times 100. Each, one after the other. So that's the common size financial statement for what? Comprehensive income. Now let's go to 2. I'll list the important ones first for the other ones. The statement of financial position, the balance sheet. Financial position, the common side is what? Total assets. Take all the items individually, line by line, and divide by total assets. Then multiply by what? 100 and get it. These are the most common financial statements. Let's look at the other two. Number 3, changes in equity. Because most of the stuff in the changes in equity are reported in where? The financial position. We use what? The total assets. So we can also use total assets. Then number 4, cash flow. Statement of cash flow position of the entity. For cash flow, we use total cash inflow or outflow. Please just focus on the first two. Just the first two, okay. But last thing, for instance, we had what? Just the financial position, no P&L or profit and loss. So that is it. So let's back this with illustration. So yes, it first, you calculate the percentage. That's the common size financial statement. That's the first thing you do. Second, then you write your analysis. So that is. So now let's back with what? Illustration. We will pick Akwesi Papa to go through small. When you're done, then you come and pick last things on to look at it small. Then we see. Okay, so this is how we look at the common size. So let's go to Akwesi Papa. So Akwesi Papa. Usually, either 2 years or 2 company. So you can compare the changes in the amount. So Akwesi Papa will be like this. First, the examiner will tell you prepare common size statement of comprehensive income and common size statement of financial position. So common size statement of what? Comprehensive income, and common size statement of what? Comprehensive income. So that will be the requirements. After that, then they will proceed and ask you to analyze using your common size statement. How do you get it? Good. So first, you have to do what we call common size statement, or we call it common size financial statement. Let's start the game. So as usual, with the financial statement, there are 3 protocols. You have to adhere to them. That's like this. Akwesi Papa Limited. That's the name of the company. Akwesi Papa Limited. Then on the line. Then I tell the examiner that common size statement of comprehensive income for the year ended 31st March 2019, right? Or 2020? Okay, so 2017 and 2018. Good. Yeah, all right, 2017 and 2018. Instead of us writing currency, no, we write currency, no. Percentage. So write the percentage here. This one is a comprehensive insurance. It will cover you to end. So it cover all the items. You can be writing percentage. So now you pick the question like this. When they move, you move. When they stop, you stop. You are copying everything. So you hold it like this. with 1 pen at the other end. So where they started from, the first item on the list, sales, then do a calculator, punch it, and then you put it in. Okay. So they start from sales revenue. That's how the sales revenue. Please, to avoid confusion, finish 1 year first before we move on to the other one. Finish what 1 year first before you move to the other one. You have to finish 1 year first before you move to the other. Why? Because the figures are different. My confusion, the base. So, and if happen that end of the figures, the sales revenue is 100,000. Oh, then now I can use the I to calculate. Sales revenue is 100,000, right? The first one, sales will always be 100. Always sales will be 100. Let's start 2017. From there, they went to cost of sales, right? So, cost of what? Sales. Cost of sales 60,000. Agreed. Okay. So, if it's 60,000, so it will be what? 60,000 divided by 100,000. 100,000 is the sales revenue times what? 100. Right? That would be 60%.
We don't need to show it.
No, here we don't need workings, we don't need formulas. No workings, no formulas. Items are many. So if we show workings or the formulas, time cannot be side. And moreover, the formula is only one. We are going to repeat it. So no must be for you. So that is it. So that will be 60. Have you seen what I've done? It. I'll put inside a bracket too. I'll take it. I'll get what? 40%. That's the best profit. That means gross profit must be 40%. Or you can also calculate that one too. That's 40,000 over what? 100,000 times 100. You put the answer in 40%. The next item on the list is what? Distribution cost, right? Distribution cost. Distribution cost is 10,600, right? So 10,600 divided by sales of what? 100,000 times 100. So you get something like 10.6. You put it in brackets. It's a financial statement. Whatever they do the same thing. When they move, we move. When they stop, we stop. When they underline, you underline. When they double it, you double it. Then you are done. So you do this up to what? Profit after tax. Dividend will not be part. Dividend is not part of what? Comprehensive income. So you should not add dividend. You earn as profit after tax. However, if you are doing trend analysis, then the dividend will be part. So you earn at profit after tax, anti-tax. Then you come and pick 2018 own, and you start. If you go it's 1 year, that one is a cool chop. If it's 1 year, cool chop, just the year, like last it is own, just 1 year. Then do the calculation for them. Don't need to show working. Throw the answer in there for us. So it can be 2 years or many. Good. So 2018 to cost of sale was 48,000 over 72. So that will give us 66 over 6,000. Automatically, gross profit will be 33.33%. Then we move on. So we are done calculating the common size for that of comprehensive income. So you continue to profit after tax. Express all the items one after the other. Good. We should not do the 2 years at the same time if it will confuse us. If not, you can go ahead and then do it. Yeah, that you have to finish 1 year because 2017, the common base is 100,000 sales. 2018, common base is still sales, which is what? 72,000. So sometimes if you are doing the 2 years not taking, you pick an amount in 2017, you divide by 72,000, and then you put it there. Meanwhile, it will be what? Wrong. So we should not do that. So you finish one, Come and pick one. Just that we have to be fast, extremely fast. But if you check last week's one, it was loaded. It was 20 items. It was 20 items. The assets were 10. Equity and liabilities were also 10. So making 20. Equity was 3. Non-current liability was 3. Current was also 5. In all, making 10, 10. So making 20 items just for 1 year. Great. Now the base. We don't have base for, how do you call it, year. Once it's profit and loss, you pick the sales for that particular year. Once it's comprehensive income, you pick the base. So for 2018, the sales revenue is 72,000, and that's the base. So the base is 72,000. Cost of sales was 48. So I pick 48,000. Divide by 72 times what? 100. You get 66.67. Then you put it in. That is it. If there's 2019 more years, the same thing that you do. Do that one to the calculation. Good. Sales is a common base, irrespective of the year. Pick the sales revenue of that particular year, and then you divide all the items by. Good. Then you are probably heading to the end. Okay. So let's do that to profit after tax. Then that's where they'll get you nicely. I'm aware that if I do this thing, they'll mark me down. And you know do it though. So they'll come and mark it down. Okay.
The profit of zero.
Then we go to the statement of financial position. Let's do that one also. That one, the common base is what? Total asset. So all the items, again, we divide by what? Total asset. So let's pick the total assets. So that one, too, when they ask that to prepare a common size statement of financial position, they said common size statement of what? Financial position. So I'll start. Akwesi Papa. There are 3 protocols. So Akwesi Papa. Common size statement of financial position as at 1st March 2017 and 2018. So 2017, 2018. Still, reporting currency is in percentage. So we are reporting percentages. When they start, you copy their format, irrespective of whether there's figure there or not. When they are adding, you add. When they are subtracting, you subtract to get the percentages. Just that over here, the common base is what? The total assets. That is the common base over here. The common base is total assets. So let's take note of that. Common base is total assets. That one to year by year so that you not confuse us. So let's start 2017 first. So they started from non-current assets, right? So they wrote non-current assets. So we start non-current asset. They start with PPE, right? So property, land, and equipment. Then we pick that figure, we divide it by total assets. What's the total asset in this question? The total asset is 58,400. I'll pick all the items individually, one after the other, and divide by 5400. What I'll do is PP happen to be, and I'll divide it by that figure. So for PP, you get something like, okay, so you get 71.19%. Round it to two decimal places. Great. Two decimal places, because some of the items might be too small. That if you are going to run it to the nearest one number, they will be 0. Sometimes 0.2%. So if run it to the nearest one number, get 0. So that is it. So we have to run it to two decimal places. Then the next item, land and building, right? Current assets. When they move, you move. When they stop, you stop the game. So current assets. When you move to current assets, the current assets will be the remaining percentage of so first inventory, right? Inventory will be the figure over 58,400 times 100. So the percentage, what will you get? Great. So now let's see. So after calculating from this, it includes liabilities, equity to stored, total assets, everything, total assets in the financial position, everything, including the equity itself, equity to total assets, liabilities to total assets. So that at the end of the day, the equity and liability, because it must balance, this will give you the same 100. Good. Then you are done. Now let's see. If you are going to write the analysis, after the common size financial statement is prepared, you now provide the meaning. So how do you do it? Here, either you get 1 year for common size, even one financial statement, just 1 year, it's okay. Just one is okay. Don't need to be given two. Unlike trend, whether we need two or more. So they can just give you one. When they give 1 year, that one, they're just looking for what you call descriptive essay. They're just going to describe the numbers, the percentage. Oh, sales, cost of sales represents 60% of sales. And therefore, gross profit represents 40% of sales. That's all. That's all the analysis. Distribution cost represents 10.6% of sales. Descriptive, 10.5, 10.6. Then what can they tell us? If cost of sales is 60% of the sales, what does it represent? Does it suggest that this company is a very good company or bad? Now, if majority of your sales are into cost of sales, it's very bad, right? Good. So that's how the report starts from. So let's put some few stuff together. So I write some items that in the profit and loss that we start from. So for profit and loss, items in are not many. So first, we talk about cost of sales. Two, we talk about gross profit. Our operating cost. For operating cost, then we will talk about our profits. That's operating profits. Then finally, interest and tax and profit after tax. That's all what I'm going to talk about. And any exceptional item. Maybe they sold a lot of goods, or a lot of their PPE, so they have a huge other income. You can also do that. So basically, they are about five, right? Operating profit, interest and tax, expenses, profit after tax. Good. Then, okay. So now, if it is only one, in fact, for profit or loss, if the item is not profit or loss, yes, they move in line, and then a profit after tax. Good. Now, for profit or loss, if the thing is not revenue or income, then it will be expenses or loss. Yes, for profit and loss, all these items. So cost of sales is an expense, gross profit, income, operating cost, expense, operating profit, income, interest and tax, expense, profit and tax, income. So for that one, if the thing is not profit, it's an expense or loss to the organization. So you check if that percentage is too significant. If it is a cost, it's a detriment to the organization. That is a bad performance. So over here, you can see that cost of sales represents 60% of sales. So that means majority of your sales are into cost. Yes, some organization for the revenue they can generate, but for every revenue they generate, they spend a lot before they can generate such revenue. That's the Papa. That's what we can see here. For every 100 Ghana that you generate, 60% or 60. For every 100 Ghana city sales that you generate, 60 cities is used to finance that or generate the sales. Good. Let's take it again. If you want to provide analysis, if it is just 1 year, for instance, only 2017, then you start like this. 60% or cost of sales represents 60% of sales. Giving a gross profit to sales of 40%. Full stop. This suggests that majority or more of sales are into what? Cost of sales. So you can sell more, but you spend more. Good. Then you assign reason why you can generate more and also spend more. Whatever you generate, spend more. You assign reason to it. Why can you, like little earning, you involve a lot of people, a lot of staff, a lot of assets that are not performing. So what if you earn more, you push all of them into servicing of these assets. You can generate more, but more like you spend more than what you generate relatively. That is good. So that is that. Then you go to operating expenses. Good. Okay. We said that if this cost of sales is 60% of sales, which is a bit high, even though it's a bit moderate. Good. So it's high over here. That is the impact on organization. If cost of sales is high, what is the impact? It means that more of your sales that you generate push into cost of sales. For the profit and loss statement, only two items you are going to meet. If it's not an expenses or a loss, it will be revenue or income. That's all. So if you check that the percentage is too high and it's a cost, that's a bad news. If it is a cost cost and percentage is too high. That's a bad word, bad news. But it's a profit, end of the profit, operating profit is high. Then that's what a good news. So that's how we provide the meaning to it. Good. Then you move down.
If the cost is high, it's bad.
Yes. Distribution cost represent 10.6, whilst admin represent 1.6. Putting all together, you get what? 12.6. So operating cost represent 12.6 of the sales revenue. Okay. If you add the cost of sales of 60% to it, you get what? 72%. That means your operating cost alone is what? 72% of your sales revenue. Tax is not in. Interest is not in. Good. So that is the analysis.
But if it's not the cost,
Great. So that's the analysis for that of the common size statement of comprehensive income. What if it's 2 years? For 2 years, you compare the changes. For instance, this question. The cost of sales to sales ratio for 2017 is 60%. It has increased over the period to 66.67%. This suggests that the company, this is
say new from
good. The cost of sales to sales ratio has moved from 60% to 66.67%, which represents a deterioration in profit. So cost of sales to sales ratio has increased from 60% to 66.67%. Good. Causing a decrease in the gross profit margin from 40% to 33.33%. Good.
there to
Decrease from 40% to 33.33%. Good. That is the end of the game. If there are 2 years, it must be compared relatively. But still, it will not deviate from if the percentage of the cost is going high. That means you will not be able to manage your cost work. So then you assign reason. It appears that Akwesi Papa does not manage it, does not manage its production and cost of sales well. Good. So Basically, that's what we will do. Then go to the financial position. They talk about the items for profit and loss, listed them there. For financial position, first, as usual, look at the PPE, the one that was the highest one, talk about it. So let's go to the financial position. So for financial position, items that we have to talk about, number one, pick one of the PPE, the one that with the highest value, the one with the highest value. So from PPE, first on the list, PPE, two, we talk about the non-current asset itself. So PPE one or non-current asset itself, the entire non-current asset. So just one PPE and an entire non-current asset. You can't talk about everything, no. Then two, you talk about inventory. Inventory and cash, just one. Then the one with the established, the must. Number four, current asset, the must. Current asset, the must. From current asset, they move straight to equity. That's number five. Then number six, go to non-current liability. So you start PP, percentage of the PP as compared to that of the total asset. So here we had 71.92. So in 2017, the PPE represents 71.92% of the total assets as compared to 72.94 in 2018. Good. Now, for all the assets, check whether the non-current asset is more than the current asset to make a clear case. Either these two companies, manufacturing company and a service rendered company, which of these two will have a lot of PPEs? The one that manufacture and the one that produce service. Manufacturing organization will have a lot of PPE. So if you calculate and the PPE or the non-current assets are more than the current assets, then such organization could be what? A manufacturing organization. So here, it's clear that Akwesi Papa Limited is a what? A manufacturing organization. Because your PPE alone is 71% of the total assets. This suggests that majority of Akwesi Papa's total assets are PPE. This suggests that majority of Akwesi Papa's total assets are PPE, and hence the manufacturing company. And the manufacturing company. And hence The manufacturing company. Now, manufacturing companies normally invest in their PPEs. Since they normally invest in their PPEs for efficient production, production purposes, they invest in their PPEs. Good. PPEs. Or their assemble plants. 5 more assemble plants. Then you are done with PPE and non-current assets. You check inventory. If inventory is high, then overstocking or overvaluation of inventory. Inventory is too high, overstocking. Then you go to current assets. Then you check current assets. Right after current assets, cash is also there. So we check cash before current assets, the cash balances. All of them, we are just doing what we call descriptive essay. So cash, check if cash is too high. If cash is too high, as usual, if your cash is too high, you are just falling it for yourself. Self-pay. There's high risk of keeping a lot of cash within the business. Why can't you invest in an income yielding investment? Keeping a lot of goods also poses high challenge or high risk on organization. Keeping a lot of goods because the more you store, the more storage costs probably you incur. Result a lot of or pose a lot of risks on a company. If you keep a lot of goods, it will result a lot of what? Risks. Good. Such as what? Storage cost, insurance, warehousing, storage costs, insurance, warehousing. And good. And obsolescence. If you store more goods, definitely some of them will probably deteriorate or spoil in the course of the game. And like we said, they're also attracting a lot of other guys to you. So that is it. Okay, then from the current asset cash, you jump straight to equity. If you go to equity, that one, this is how you put it. When you go to equity, tell us if the percentage is, let's say, 20. You said that 20% of the total asset is being financed by what? Equity. With the remainder debt, 20% of the total asset is being financed by what? Equity. Good. 20% of the total asset is being financed by equity. And then that is it. Then you go to non-current liability or total liability. That one too. If it is 30%, then 30% of total asset is being financed by what? Debt or non-current liability. 30% of total asset is being financed by what? Debt. That long-term debt or just debt. Good. Good. So that is the end of the common sites. I place some material on the platform so you can access it and look at it.